Is there a safe spot in today's condo market? Or rather, a correction-proof spot? Hi, I'm Jemima Codrington, and welcome to Investor Insight on Crew TV. Ducking for cover is easier said than done for investors in today's condo market. No one less than the Bank of Canada is warning that the market may be headed for a price slide. Investors are understandably worried, but what can they do?
Generally speaking, real estate tends to be a long-term play for people. And if it is that, I usually advise them to go into boutique buildings. And the reason being is because I find that neighborhood buildings, and the ones that are low-rise, tend to create a community. And they tend to be more in demand. They're a well-taken care of building. And what they create is an ecosystem within that building. What you find in the high-rises that are primarily renter-owned is that they're a bit transient. So neighbors don't get to know neighbors. So it's tough because at one sense you're telling investors to invest in a building that's not investor-owned, but those usually are the best ones.
One of the things that I'm asked by buyers all the time is, where should I be looking to buy my condominium to rent? Downtown Toronto condos are expensive, no doubt. The rents are higher. But what I use is a ratio called the rent to price ratio. I take a look at the monthly rent over the sales price. I did some numbers for early 2012. Downtown Toronto, a project by a major builder, the rent to price ratio I had calculated as 0.47%. The same builder in Scarborough, for the same size condominium, was 0.51%. We're looking at about a cash flow difference of $400 a month. In addition to that, some really great value markets. In New Toronto, there was a project by a prominent builder where the rent to price ratio is 0.57%. We're looking at, that's close to $500 to $600 a month more in net cash flow in those particular projects. So it really does depend where you buy, at the right price that you buy, and the quality of tenant that you get to pay the rents.
But what if you've already bought? There are many strategies that investors overlook.
There are a number of things that investors can do when the oversupply hits. Marketing, I think, is going to be the key factor. The first thing you want to do is make sure you differentiate your ads. The one-liners, it's not just a one-bedroom for rent. Maybe try cozy one-bedroom, come snuggle up with me. You want to get the attention of your prospective tenants above all and above your competition. The other thing you might want to deploy is perhaps look at furnished suites, especially in the downtown core. Furnished suites can easily yield, between $300 to $400 net cash flow per month, and that's a strategy we've found successful with our investors and our units.